Be Wealthy and Smart, episode 1248.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the Fed and spending, because I'm going to give you my opinion about what the Fed is going to do at the FOMC meeting on Wednesday and what that means to consumers and how they're changing their spending. Now, first, I've been talking a lot about how I think the Fed is going to pause. I think there's less than a 1% chance that they will actually raise rates at the meeting on Wednesday. That doesn't mean that their inflation rate is exactly where they want to see it. It's still over the 2% target that they have set. But things have been moving pretty well in the right direction, except for the last two reports. Those were a little bit more anomalous, I think mainly due to a blip in energy, and I think that's going to work its way through. Remember, there's a time lag between when interest rates are hiked and when we actually see the slowdown, when we see results. And that really hasn't happened yet. It's going to happen, I think, closer to sometime in the fourth quarter, toward the end of the year. At that point, it's going to be painfully obvious that inflation has come down quite a bit more than was expected, and it's going to change the Fed's plans going forward so that they will be able to ease into next year. Now, recently we saw the national debt crossed $33 trillion. And the unfortunate thing about the Fed raising interest rates is that most of that debt is interest. In the meantime, 92% of adults have said they cut spending in the last 6 months. But more importantly, they have plans about cutting spending going forward, particularly during the holidays. And that's what I want to share with you right now. According to a survey on behalf of CNBC by Morning Consult, a company that conducts survey research to inform decision-making, 4,403 U.S. adults were polled recently. And as I said, 92% have already reduced their spending over the past 6 months. The spending cuts were on things like clothing and apparel, 63%, restaurants and bars, 62%, and entertainment outside the house, 56%. That was pretty much true also in the June survey. So people are still not buying as many clothes, eating out in restaurants or bars as much, or going out for entertainment. The next biggest cuts were in groceries, 54%, recreational travel and vacations, 53%, and electronics, 50%. But it's really what's coming ahead that is going to be slowing down the economy. And that is, during the holiday season, 3/4 of all U.S. adults surveyed, 76%, plan to cut back on spending for non-essential items, and 62% expect to cut back on essential items, sometimes or more often, over the next 6 months. More than half, 55% of households earning $50,000 or less, said they're feeling the impact of the economy on their personal finances, while 61% of households $50,000 to $100,000 and 46% of households making at least $100,000 plus reported the same. The area that was impacted the most since June was the higher income area, who had the most improvement, where before, in June, 55% said they were feeling a negative impact on their finances, and now only 46% of those making $100,000 plus said they were feeling a negative impact on their finances. And higher income households are in fact moving toward feeling that the economic situation is having a positive impact, 30% in September, up from 21% in June. But nonetheless, people have already decided they're going to cut back some of their spending at the holiday time. So we're already seeing many consumers saddled with debt and feeling like items have gotten a lot more expensive, which has made it difficult to keep the same amount of salary buying the same amount of goods or paying the same amount of rent. So it's pretty natural to expect that where they have discretionary spending, they're going to be cutting back some, and that just happens to be right around the holidays. So in the FOMC meeting on Wednesday, we're going to hear a lot from the Fed about what their future plans are, but it is based on rear view mirror looking metrics. They don't use forward looking numbers. Everything is pretty much a rear view mirror number. And what I think is really left out of the equation is just that lag time that it takes for the interest rate hikes to really kick in and slow the economy much more than it was expected. That's what I think we'll see in the fourth quarter. And as corporations are putting AI to work, we're going to be seeing more profitability at the bottom line, which is going to fuel stock market profits starting later this year and into next year. The lower inflation with the higher profits is going to set off a very bullish scenario starting sometime around the November time horizon. So between now and then, it may be a little rocky, but hang in there, things are going to get better. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.